Reading price charts, bar by bar, the technical analysis of price action for the serious trader. Chapter 4, Pullbacks. Table of contents. First pullback sequence, bar, minor, trendline, EMA gap, major trend lines. Double top bear flags and double bottom bull flags. EMA and gap EMA pullbacks. 2HM. If away from EMA for 2 or more hours, then fade the EMA and the first EMA gap bar. Trend day. 11:30 stop run, pullback to trap you out. Counting the legs of a trend. High, low, 1, 2, 3, and 4. Variations of a high, low 2 setup, and then 3 push pullbacks. First pullback sequence. Bar, minor trend line, EMA gap, and major trend lines. A pullback is the first bar against the trend that goes past the prior bar's extreme. Pullbacks happen within a sequence. The first pullback is usually minor. As the trend progresses, the pullbacks can become deeper. The first pullback is usually small with 1 to 2 bars, followed by a new extreme. Minor trendline pullbacks can have 3 to 5 bars, followed by a new extreme. EMA pullback is when the market has been trending away from the EMA for a couple of hours and finally touches it for the first time. EMA gap is when the pullback goes beyond the EMA. A major trendline pullback is broken by a counter trend move. Often will retest the previous swing high or low. Throughout this entire slide, I've used the same bullish and bearish charts because the chapter is building upon the same charts. So I want to keep going deeper and deeper within these charts. First pullback sequence, bullish. Here we see the breakout above the EMA with good follow through. This is the first pullback because it's the first bear bar, and that also leads to a test of the prior extreme and a new high. Then we pull back into the EMA, and this becomes minor trendline pullbacks. Very shallow, bear bars are not getting follow through, and you could buy them and make money. The market trends for about 2 hours around here without touching the EMA, and that creates the first pullback to the EMA right here. You can see a very nice big gap bar, but bulls buy it, and that also tests the prior high and creates a new high. Here we see at the end of the day, it's the EMA gap. The bear bars are being put under the EMA and starting to create gaps. Here's the first pullback sequence within a bearish trend. Breakout below the EMA starts here, and the first pullback starts after the first bull bar gets put in. So we have the breakout, bull bar, and this initiates the first pullback, which now we are in a channel phase. Here we can see the stock pull into, this is the E-mini. Here we can see the E-mini pull into the EMA and start to sell off. This would be the minor trendline pullbacks for the bears. The first pullback to the EMA was a good sell, however it didn't reach the absolute low. Here we can see a small pullback. It's late in the trend and it still led for a profitable scalp. Here is the EMA Gap Bar, this strong bull bar right here. The bulls put in a good bar, however there's no continuation and it ends up selling off for the rest of the day. Double top bear flags and double bottom bull flags. Double tops and double bottoms are with trend setups. The market can go sideways after a trend. Look for a double bottom in a bull trend, look for a double top in a bear trend. The first spike can act as a magnet. When the market comes back to test the prior swing, the previous set of traders will look to defend their stops and overwhelm the counter trend traders. These are the traders responsible for creating a double top or double bottom within the trend setup. Here's a double top bear flag. I put the lines a little bit higher so we can look at the wicks and understand how people are getting trapped and how the first one acts as a magnet. So the market creates a bear pull right here with a breakout and a pullback. Bulls are getting trapped right here and we can see the wicks. This creates a magnet for the bulls. It's the first spike in a double top. The market comes back here, bulls get out at their original entry price, and that creates enough selling pressure for bears to make it move lower. Bulls are selling out of their longs, bears are selling short. Same situation. That's the context that creates a double top with trend setup. Bulls get trapped, they hit out, and that creates the top and it sells off. Same thing but the opposite for the bulls. Double bottom bull flag. We have a strong pull and a pullback. Here we can see the pullback pulls into the EMA. Bears get short on the EMA. They get trapped. This creates a magnet. The market comes back, relieving them so they can get out at break even, the bears, and then bulls buy the EMA. Bears buy back their shorts, and that creates enough buying pressure for another leg higher. It's the trap traders that create trends that make them higher. See, bears get short here. They buy back their shorts, and bulls buy lows. And they go again. Double bottom here, here, and here. Double bottom here. Bears get short. It comes back around right here. They have an opportunity to buy back their shorts. Bulls buy the bull flag. Bears get out of a bad trade, and the market moves higher. Same situation right here. EMA and gap EMA pullbacks. Gap. 2 points of space on the chart. Open above yesterday's high will create a gap. Open below yesterday's low will create a gap. There can be gaps between bars and the EMA as well. This is a bullish gap. We can see the market was range bound and they closed right here. There's a big gap up, a pullback to test a high, and then a bull trend. Just because there's a gap up doesn't mean we're going to trend every day. In this case, it made sense, and we can see the gap up breaking through the yesterday's high. Bearish gap. Here's yesterday's swing low. We can say the absolute low is right here. And there's a really big gap down, but no continuation. This could be considered a gap. These bars can be considered a gap before the bulls buy them back. And here's also a gap, the price from the EMA. Gaps are a way to show which side is. Gaps are a way to see which side is showing strength. So they are very important. They're not just opening gaps. There's gaps all around the chart. 2HM. If away from the EMA for 2 or more hours, then fade the EMA and first EMA Gap Bar. When the market is in a strong trend, it can stay to one side of the EMA for 2 or more hours. This shows the trend is strong and there is a gap between the price and the EMA. The first time the EMA is touched, traders should take it for a scalp to the recent swing. 2 hours is just a guideline. It's not a magical number, and trends can be just as strong even if it touches the EMA 4 times within 2 hours. Each time the EMA is touched, it can penetrate more than the prior touch. Once a gap bar has been put in after a strong trend, fade it to the extreme. So here's the same chart we've been looking at. We're seeing all these new setups, trend lines. So when the market's trending for 2 hours, we're looking for the first touch here. Here's the first touch, here's the first touch, here's the first touch. See how many times the market got touched and it still went higher? So it doesn't mean the market's getting weaker with the amount of touches. However, right here, the market does actually trend away for 2 hours and keeps a very good bullish gap open. And then look what happens on the first bear bar that gets put in. It's bought. Because it's been trending for 2 hours, this is the first discount. Bearish. 2HM bearish. So here we can see the bear trend's been going on for a while. Here it has been about 2 hours. We touched the EMA, and bears see that as an opportunity to get short right away, and they do that because that's the best price they've had for 2 hours. The market trends for another 2 hours and starts to go sideways. This was the best price they've had since here. You could short here, but technically we're shorting below the average price, so these would be scalps, and then bears start to get value entries above the EMA. As long as the context makes sense, here we can see no follow through for the bulls. It pulls back and bears get their higher low. So that's that gap, and the trend continues. Trend day, 11:30 stop run pullback to trap you out. On strong trend days, there could be a counter trend move around 11 a.m. to 11:30 a.m. PST. Sometimes this move can come before or later. Institutions will use this pullback to add on to their positions. They will look for a test of the prior extreme. I wanted to really emphasize the time of the day, so these are 2 different charts coming up. Here we see a strong trend that's been going on for about 2 hours, and the move gets climactic right here. We have 3 pushes higher, and they're really nice bull bars. We see a strong rejection by the bears at highs and a deep 3-legged pullback. This pullback doesn't go far, and bears don't put any bars below the EMA. It ends up testing this bull flag right here, about 5-6 bars, pullback, and breakout. That's where the bull stops are located, all around here, and institutions will know that. They will hunt your stop, tag you out, get their discount, and go for a test to the prior extreme. Here we can see it ultimately didn't happen within this day, but the next day it gapped up and they would make money. Bearish, 11:30 stop run. Here we can see a strong bear trend going lower all day. It's 11:30 to 12ish, right around here, right around there's the time. We were breaking down leg 1, leg 2, leg 3, and they go for a deep pullback. This is a bear flag, and this is a strong bar. Stops are going to be here and here. The bulls know that, and institutions know that a deep pullback could be coming up, and that's what happens. Look, the EMA acts as resistance. It takes out all the bad stops, and then it goes for a few legs lower. Counting the legs of a trend. Trends can have 2 legs in them. Often, if a counter trend move is strong enough, traders will begin to wonder how many more legs we can get. Here's the bullish 2 legs of a strong pull from the bottom of the breakout to the top of the strongest pullback. This looks strong enough for bears to go for a second leg down, but it ultimately fails, and bulls get their measured move all within one day. So this is a really strong trend and has complex legs between them. Bearish 2 legs. Here we can see that I measured from the gap down because this is kind of a strong pull and these bars are really strong, so bears are getting follow through. This is the first bull bar, so that tells me it's a pullback, so that's why I measured from the top of the gap down to the right before the pullback, and I put it to around the high of the deeper pullback, the EMA pullback, and that was meant right here. We can see bulls going for traps, but it ultimately fails and the trend resumes. So the measured move for 2 legs was easy. It's if you didn't want to completely count legs, you could do measured moves if you can identify the day is trending. High, low, 1, 2, 3, and 4. High, 1, 2, 3, and 4s come after a pullback in a bull trend. These can be good with trend setups. Lows, 1, 2, 3, and 4s come after a pullback in a bear trend. These can be good with trend setups. High, low, 1, 2, 3, and 4s are everywhere in tight trading ranges. These should be avoided as new traders can get whipsawed. Bullish high 1, 2, 3, and 4s. Counting high 1, 2, 3s, and 4s and low 1, 2, 3s, and 4s are somewhat subjective, but I'm doing it just from a pullback and a very basic, the way the book was demonstrating. I really recommend if you want to get practice learning how to count to do it live and mark up your own charts. So here we can see the breakout and a pullback, and this bar creates a high 1. That's not a good trade because a high 1 is usually in a channel of the opposite direction. So this is a high 1 in a bearish channel after a bull trend. It's a pullback. Here we can see a high 2 because it's a new high made after the bearish channel. So that tells us since we're getting it at a worse price, this could be a better entry because there's more information. High 3, we get the pullback and then a new price. It's around the same price as the high 2, but there was a pullback. And then finally the high 4 is coming at the worst price, but we get the most information. Bulls are buying the EMA and they're buying higher. And that's the price you pay. The longer that you wait for the high 1, 2, 3s, and 4s, the more information you get, but the worse price you get. So here's a pullback and a high 1. Here's another pullback and a high 2. At this point in time, we know the market's going up. At this point in time, we don't know if the market's going to be a failed breakout. So you're paying for information at a worse price. You're paying for more confirmation. High 3 is a little bit worse than a high 2, and it comes after the bull flag. And then look at the high 4. It's the worst price late in a trend, but it also had follow through. So in good trends, you will make money, but the problem is, can you spot the good trend and act accordingly? Are you going to get caught in this range? This is a tight trading range where Al says it's easy to get caught up, and it's very easy to start shorting these bars. So this would be an example of when not to short in a tight trading range. Bearish low 1, 2, 3, and 4. It's the same situation for the bears. There's a spike and a pullback, and that creates the low 1 around here. See the pullback, and then this bar is the low 1, and then another pullback and a low 2 at a worse price. Low 3 is at a worse price, and the low 4 comes after this pullback at the worst price. The trend has been going on for about 2 hours now, but each time a new low gets printed, we get more information. We can see if we got short on the low 1 here, it would be you would immediately get trapped, but you could also hold because there's a lot of bearish pressure, if that makes sense. However, the low 2 went opposite bar and it goes. The low 3 went. The low 4 it started to go sideways, but your price you would see a little bit of red. So that's up to you to decide. Here's another low 1 here. We have a pullback and a low 1, and then we have a micro channel blind break in between these two bars, and that creates the low 2 at a worse price, and it goes right away. Variations of a high-low-2 setup. The reason high-low-2 setups work great is that they show the market has tried twice to go in one direction and failed. When one side fails twice, the market can make a move to the other side. Sometimes the market won't give you a perfect signal. There's lots of money to be made if a trader can learn to look for variations of high and low 2 setups. Bullish high 1 and high 2. Remember all the high 1, 2, 3s, and 4s we saw? That's a lot of counting, but look, it's the same information. So here we see a pullback. Here the bulls make a move, and then this is a pullback, and that creates a high 1. That's a high 1 in a bear channel, but look at the high 2. Off the EMA, better information, and then you can go for another move right away. Here you buy, you get stuck for 15 minutes, you get stuck in a pullback. Here you buy, and you're in profits. Same situation here. Look at the bull flag. We have a good bull flag, and then it starts to go sideways. If you bought this bar, you would sit through another pullback before you buy this bar, and even that bar had a slight pullback. This would be the high 3. But the high 2 would give you more information, and this bar right here on my mouse is just trading above this range. This bar closed within the range, this bar closed above, so it gives us a little more information. Bearish low 2. Here's that strong breakout again, and here's that low 1 I pointed out, and here's the low 2. It's more information. It's an easier trade. This low 2 is breaking out of the bear flag range. Here's that double top. Market goes sideways. Bulls get their 2 legs. It fails, and the low 2 is printed for the bears. Low 1 and low 2 down here. Here's a bull bar. Here's a bearish pull, and that goes sideways into the EMA. Bears try and go for the breakout here, but it reverses. This could be a low 1, this could be a low 2, this is a low 1, and this is also a low 2. There's many ways to count, but the idea is to train our eyes to just spot them and take the trades. With trend trades are always better. Low 2s, high 2s will always have worse entries. If the high 2 and low 2 doesn't have a worse entry, you could get trapped, because the whole point of a high 2 and low 2 is to get more information. So if you're getting a better entry and better information, your premise might be a little bit off. And I'm pointing that out because that's actually saved me so much taking bad trades, because it just makes sense. High 2 or low 2 in this case, right? It's breaking out of the channel. Look at this low 1. It's still in the channel. The bulls can reverse, but the low 2 is a breakout. So it's important to start recognizing at least high 2s and low 2s. 3 push pullback. Just like 2-leg pullbacks, trends can have 3-leg pullbacks. This can happen within the middle of the day as a trading range. The third leg of the pullback will trap traders into a bad trade. There's usually low momentum within these 3 pushes. So the same exact chart. This chart I thought was really nice because it displays everything within the chapter for the bulls and the bears. I hope you guys are finding value within this, because I learned a lot just from, instead of looking for new examples, I kept going back to the same chart. Here we see 3 pushes down for the bears. 1, 2, and 3. This actually looks, I remember this trade, and I got short here and got trapped. This looks really nice for the bears because there's a lot of bearish momentum. We are trading within a range. However, it's getting weaker. Look, big bear bar, not so big. Big bear bar, and then 3 bear bars that go nowhere. They can't even get past the EMA. People get trapped, and bulls bought that and trapped the bears, and they kept going. Bears had to hit out or they were just losing money. That creates a trend. That's a 3 push pullback. 1, 2, 3, wedge bottom. Bearish 3 push pullback. Same situation. Look at this huge bear pull. It's a bear flag. Here's the high of the range, the high of this bull bar, and the low. The 3 pushes up are 1, 2, and 3. That creates a wedge top within a range, and the momentum's really bad. After every bull bar, there's a bear bar. Here, bull bar, bear, bull, bear, bear, bull, bear, bull, bull, bear, bear. So it's not good. You can see how the momentum is getting weak for the bulls in a bear trend. It's better to always take with trend setups and wait for that nice entry. You can get short here, here. Here's a low 1. Here's a low 2. Here's a low 3. That's a low 4. So you can see how counting can really start to help within trends, and you can just start adding to your position, adding. But as long as it makes sense, as long as your premise is valid, I want people to just add to their accounts and it blows up. So that's the 3 push pullback for the bears. It's creating a range, and it creates a wedge top bear flag. This is the end of chapter 4. Please leave any questions in the comments and I will try my best to answer them. Thank you for your time, and if you learned anything, please consider subscribing.